Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice for the mortgage industry, and this is The Mortgage Voice. You can see us and hear us on a number of different podcasts around the country, whether it's on Apple or Google Music Play or Spreaker or any number of other podcasts. We are on the Big 8, as well as being on YouTube. My YouTube channel is Jeff Barton, The Mortgage Voice, and you can see this show as well as many other shows that we've been doing over the past 5 or 6 weeks concerning the coronavirus and historically on a number of different topics and years. We bring to the show speakers, people who are guests that are in the industry that can try to help us find out products, the type of things that we're going to need in order to get a loan nowadays. So anyway, if you're out there right now and you're listening to the show, thank you very much. If you go to any of these places to see the show or hear the show, please leave a review. Click on any bell that's available there, especially on my YouTube channel, so that you can get updates and notifications of future shows. We are also doing on LinkedIn and Facebook a Mortgage Minute update, probably 5 times a week. Now, I think that with the change that is happening in the industry, as well as the constant updating of new requirements or lessening of requirements that happen almost daily. I don't know if anybody out there is aware, but this week we had one of the most volatile weeks that we've had in oil prices. And in past shows, in years past, we have shown how oil prices in certain areas of the country and certain areas of the world affect your mortgage rate. And that is certainly the case now. One of the things that we do not want to see is bottoming out of any market, whether it be the stock market, the oil market. The reason being is that there are millions of people that work in those particular fields, not only here in the United States, but around the world. The appetite for mortgage-backed securities, which are the basis by which we do lending, i.e. when we do a loan for you, whether we are the lender or whether we are a broker who is allowing another company to lend, that loan in and of itself is important because it gets bundled with other loans and sold to Fannie Mae or Freddie Mac, especially if they're conventional or FHA. FHA would be going to Ginnie Mae, of course. Those loans then get bundled together and sold as a product based on the amount of interest you are paying on your loan. Those investors purchasing those particular products are expecting a return. And those returns have been rock solid for about 10 years. What do I mean by that? The default rate up until the last 6 weeks has been near historic lows. We usually get about 3% default rate per year. It was down around 1.5%. And that's a big deal for an investor who can guarantee, let's say you're in some foreign country, let's say you're in some industry which is volatile, which goes up and down a lot, and you're looking to park your money, you're looking to get a safe return on your money. If you're an individual investor, you're going to buy real estate and rent it out, although that's become less of an attractive feature in certain states that have gone to the bias of protecting the person who's renting more than the person who's risking. However, if you are buying mortgage-backed securities, you, along with many, many other people, look at either buying treasuries or mortgage-backed securities. These are the two benchmarks of investments that are out there currently that foreign investors and major U.S. investors, i.e. hedge funds, people who are invested in large funds for either the teachers union or some such, they're looking to those two investments as some of the safest investments that you can be in. Currently, what we have is a not so sure investment. And if loans themselves can be bought and sold very easily or packaged and bundled into mortgage-backed securities, the liquidity, i.e. the money is like the blood in your veins. It's like the water in the river. It's got to keep flowing or there's a seize up in the system. And that's a bad thing. The reason being is that in 2008, as we all remember, anybody who was around at that time, and there were certainly many of us that were, saw that the credit, what they call credit, which is what we're calling liquidity, the water in the river, the blood in the veins, that seized up. It did not move. Therefore, nobody was buying mortgage-backed securities, nobody was buying treasuries, and nobody was lending in order to package those products together to be resold. So, i.e., overnight in 2008, the entire lending industry stopped. The only thing we had going at the time, which is very similar to right now, although the liquidity issue is not an issue currently, but it could be, the only difference right now is Fannie Mae and Freddie Mac are buying loans. Ginnie Mae is buying loans. I talked to my warehouse lender today. This is the bank, the lender that gives Malibu Funding, the company that sponsors this show each and every week. I want to thank them for doing that. And I also want to say thanks to our radio station partners, KMET, KCAA, K-Tahoe, and K-Ship up in Las Vegas. All these fine radio stations are doing a service by putting our program on. The reason the service is, I think it's a service, is because people have to know the reality of what's happening in the mortgage world, not just some commercial that's out there saying we're the best, come to us, nobody else can do it, because that's not true. The liquidity in the market is what's fueling either doing loans or not doing loans. Understanding that is our way to present to you what's really happening in the lending industry. So given that, if in fact it is, well, it's not like it was in 2008, Fannie and Freddie and Ginnie are buying. And as I was saying, my mortgage warehouse lender, I spoke to the gentleman this morning who is our VP over there. He told me that conforming will be purchased. Now, a conforming limit, what is that? If you go to your individual county, type it in and ask Google to show you what the conforming loan limits are in your county, they will tell you in LA County or in San Bernardino or Riverside counties or up in Clark County or up in Tahoe or Sacramento or any place in where you're receiving this information or listening to the show, it will show you what conforming limits are, which means that they will be purchased by Fannie Mae or Freddie Mac, which means that all the lenders out there, Big Five Bank or any of these other mortgage bankers, mortgage lenders, the loans that they're going to do that fit those conforming limits will be purchased by Fannie Mae and Freddie Mac. And those loans have changed their criteria in terms of what exactly you need to do in order to get a loan. Now, overlays, we've talked about it before on the show. Overlays are something that the lender puts on the loan in order to continue to securitize their risk. What does that really mean? It means you're going to pay more money so that the lender is more secure. Fannie Mae and Freddie Mac may put their own, overlays onto the loan, but not necessarily. So in all of this, let's say 40% of the loans being done out there are in this bubble or in this bottle. They'll continue to be done. Other loans, and we'll talk about this in a future segment on the show, we'll talk about non-QM loans, down payment assistance programs. We've got a great show coming up for you today. A lot of lenders are going to come on and talk about products that they're offering and what they're doing to help you in the coronavirus era. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. This is The Mortgage Voice. If you want to see and hear us each and every week, you can do it on any podcast. We're on the Big 8, certainly Google Music Play, iHeartRadio, Apple Podcasts, any of the Big 8. If you do go there, please leave us a review. The reason is because the more reviews we get, the more people can find us. And some of this information you cannot get anywhere else. Most of these mortgage shows are rah me and come and I can solve all your problems. We don't try to do that. What we're trying to do is provide you information, especially at a time like this, that you can use. If you also want to see us on YouTube, you can go to YouTube. Jeff Barton, the Mortgage Voice. That's my channel. If you go there, see me, click the little bell, and you can get notification every time we have a new show, which is weekly. We have 200-300 shows there. We've been doing it for 5-6 years. We're on 4 radio stations in several different locations, 2 different states. Thanks very much for listening. With us is a guy who can supply us some of this information, certainly some solutions in the DPA world. It's Jason Lowther from Mountain West Financial. Jason, how are you?
Hey, Jeff, I'm doing great. Thanks for having me today.
Okay, thank you very much. Is the audio any better?
It is, yeah.
Oh,
It sounds
excellent.
great.
Okay, fine. I want you to describe to us what you're doing in down payment assistance, if it's changed at all in this market, and just fill us in, because I think a lot of people really need that kind of help.
Yeah, no, for sure. Yeah, again, thanks for having me, Jeff.
Sure.
The world is definitely changing, especially in our industry, and down payment assistance programs have become more popular. Although, because of what's going on in our world right now, a lot of lenders have actually they pulled out of it. And
Right.
Mountain West Financial, being the #1 down payment assistance lender in California, we're just kind of stepping up, and we're there to support, the broker community and their borrowers. And a couple of things have tightened up, but for the most part, it's business as normal, Jeff.
Okay, tell me let's go back to school, right? Tell me what down payment assistance is and what type of programs you work with here in San Bernardino, Riverside counties, as well as some of the other counties in California.
Well, great. Yeah, no, for sure. Well, actually, we do all counties in all counties in California, and we're doing the CalHFA program, which is you can do a first, second, or you can do a first, second, and third. We're also utilizing a program called the Platinum program, which has 2 different programs. One could be a silent second, and you can do this either conventional or FHA. And you can get either anywhere from a 3 to a 5% grant, which is forgivable at closing, depending on what type of lines of work you are in. Now, for public employees, such as police officers, nurses, especially our nurses and our healthcare workers right now, firefighters, these grants, whether it be 3 to 5%, are actually forgiven at closing, Jeff. And the
Wow.
interest rates are actually lower than what you can get right now in today's marketplace.
That's a terrific program, and you're still doing them. Well, do you keep all these loans? Do you sell them off to somebody? Because a lot of lenders are not doing loans like this because they don't know what to do with them.
Well, no, great question. For instance, a lot of these government programs, they have their own investors, the GSFA, the Platinum program. They have their own investors. So U.S. Bank kind of services those, and then you have CalHFA. They have Lakeview, and Lakeview does all the servicing on those. So
Right.
we just deliver them a signed, sealed package, and they service these.
Well, that's excellent. Okay, so in California, this CalHFA loan, can you explain a little bit about what that is?
Yes, for sure. So it does require a 660 credit score,
Okay.
and you can go FHA and or conventional, and it would be a 96.5 FHA,
Okay.
and you can do a 3% and or max of $10,000 on a silent second, no payments, and you could do anywhere from a 2 to a 3% zip, which is the third, which helps for closing costs. So the second and the third is actually utilized for down payment and or closing costs, which also includes the compensation that is paid to the broker.
I see. So, and what are the loan limits? This is all depending on what county you live in?
It is, yeah. So the nice thing about CalHFA, Jeff, is that you can actually do high balance with this program. It's the only down payment assistance program that we offer that allows you to go high balance, which is very nice. And there's income limits on these, but the income limits are they're very high. For example, I think Orange County is pushing 200,000, so right around 193, 194,000 for income limits.
And how is that determined? Who determines that? Is that more like a HUD issue, or is this a state by state, or?
Well, each down payment assistance program, they put out their income limits. So, for instance, California, at the beginning of every year, they put out what their income limits is per county. So, 193, 194,000 for Orange County is pretty good, especially for a first-time home buyer.
I think that's excellent. I mean, I know that Orange County in particular has a very high medium house range. I think it's over $1 million. But in certain areas, like we service San Bernardino, Riverside, some parts of the other counties, and certainly up in the Tahoe area and Las Vegas, Nevada, all of these prices that you're talking about in those communities are probably ranging no higher than 500,000 for this type of program. There's plenty of response that you're getting from borrowers out there. How is the program going? How is your?
Well, like I mentioned, this is just for California, but
right.
I can tell you that we're seeing a larger demand than I have ever seen. I've been with Mountain West for 12 years, Jeff, and I can tell you the last year and a half, down payment assistance has been more accepted, not only from the broker community, but from the realtors out there. The realtors are realizing that this is just another tool for them to help their borrowers get into a home. Now, keep in mind, a lot of borrowers, they think they still need to come in with 20% down, and that's not the case. And unfortunately, they still believe that. So, there's some very sharp loan officers and realtors out there that are really taking this down payment assistance program. They're hitting it. They're hitting it hard. And then, with the way our world is going, and new millennials coming into the market space, a lot of these borrowers don't have the extra funds for down payment. So this is just another tool that the loan officers, the brokers, and their realtors can put in their toolbox to help provide the needs of their clients.
You supplied some great information. I want to now have a little bit of a switch up, put on your prognostication hat. How long do you think this coronavirus is? What are your people saying? How long do you think it will last in terms of the shutdown? And when do you think people will be back to work more the way they were prior to this?
Oh, Jack, you're putting me on the spot. You're asking.
Come on, everybody.
My dusty crystal ball, man.
Yep.
That's funny because I get people asking me what are rates going to do too, and
yep.
Obviously I do a lot of research, Jeff, and everybody has their views on the COVID-19. I think I think California's taken some pretty good precautions. I think they've done a great job. I think our healthcare has done an amazing job, and I think, looking at the statistics and everything, I'm thinking, I know our president put out, a 3-step, and he's leaving it up to the governors. And so it's just, right. I think it's just going to depend on what Governor Newsom decides to do at the end of the day. It could be, a couple of weeks. It could be, a month from now. But I will tell you, obviously, I heard that they're opening up golf courses and
gyms too.
And I know on the East Coast, they've opened up, gyms and hair salons, so on and so forth. So hopefully it trickles to California.
Jason, thanks for coming on the show. I really appreciate it. Great update on the down payment assistance programs, and we'll talk to you soon.
Thanks for having me. Take care.
Thank you, too. That's Jason Lowther from Mountain West Financial. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. You can see and hear me each and every week on a couple of radio stations in San Bernardino, Riverside, KMET and KCAA, as well as K-Tahoe up in the Tahoe area, and KSHP, K-Ship out in Las Vegas, Nevada. You can also see us on my YouTube channel. If you go there, Jeff Barton, the Mortgage Voice, you can see this as well as other shows that we've done, especially during the coronavirus emergency that we've been going through. We have a Mortgage Minute that we're on LinkedIn and Facebook and a bunch of other places. You can also, we're on a bunch of different podcasts, the Big Eight. We really appreciate people who listen, but more importantly, we want to get information to you because what you are is people in need, and I think we can supply some answers. One of the guys that I spoke with recently, I met him through LinkedIn. I really appreciate his willingness to come on the show and talk to us from Mortgage Bank of California is Mayar Dalal, and he joins us now. Mayar, how are you?
Excellent. How are you guys? Thank you for having me on.
Thank you very much, too. And I think we're aligned in a lot of the same thoughts in terms of trying to help people who are in need in a time of crisis where people are searching for certain products that may not exist anymore. But thankfully, your bank is lending those type of products. And we're talking about the non-QM space, the jumbo products. Tell us a little bit about who you are, who the company is, and then some of the products that you might be able to offer.
Sure. So my name is Mayar Dalal. I'm one of the managing directors of Mortgage Bank of California. We've been around for the past 15 years. I've been in the business over 20. It's a family-operated business. My wife runs operations. She's been a DE underwriter for 25 years.
Great.
We underwrite, we fund, we do everything in-house. And thankfully, we were 95% consumer direct. So we really didn't get affected as hard as some of the other counterparts that we have in the business, because a lot of that business was broker business, and they ended up having a lot more exposure with loans on their warehouse lines.
Right.
So we were able to come back much quicker, thank God.
Excellent. No, it's good. Obviously, you've been around long enough, and your company's been around long enough, so you've been through this type of event before. How has it affected your product line, or has it affected your product line?
I mean, it's definitely made it harder to transact because the criteria it was so expansive before where you could get financing 90%, some cases 95%. Right now, the box is much tighter. You're looking at 70% on a full documentation loan and 55% loan to value on bank statements loans. And that's where the market's trading at right now. Do I think that it's going to open up? Probably, but I don't think immediately. I think right now, just, people are worried, and this is really, it's not institutional money. It's not Wall Street money. This is portfolio money that's going into this.
I see. Thank you for explaining that. I think a lot of people get confused about where funds come from, what liquidity is, how exactly do we fund loans, why is this person able to do it versus somebody else who isn't able to do it. So understanding your business model, you said that you're lending on 55% loan to value. Is that right?
Yeah, 55% loan to value on bank statements. We can do it owner, non-owner, and second home. In addition, we are lending, the minimum loan amount is 510, like 515 actually, just call it easier. It's got to be above conforming loan limits. So we can call it 515 for, and that also takes us out of any compliance related stuff that may come out. And we are working on a program that can lend below the conforming limits. We're probably going to roll that out in the next several weeks. And currently there are no DSCR programs where you just cover with the rent. We're working on rolling that out as well, a DSCR product probably in the next 30 days. But for right now, everything has to qualify with bank statements, owner, non-owner, and you have to, and it'll either be full doc as well.
Are you looking at any interruptions in employment or any, unemployment benefits as part of your qualifying, or you're only going to take people with uninterrupted income?
As of right now, it's uninterrupted income.
Okay.
There has been talk about giving some type of concession to those that are trying to qualify that have had interruptions. But as of right now, it needs to be full, full pay throughout this whole time. And really, the challenge is with all of the numbers that have come out in the last couple of days in terms of the number of forbearances and the number of, people that aren't making their payments. And, there's concern about, these types of loans and if the pay will be an issue. And if you start basing it on people that are on interrupted income, you might have some performance issues.
Yeah, no, I agree with you. I wanted to ask you, switch gears a little bit. The Fed, Treasury, buying mortgage-backed securities and treasuries, they've scaled it back from the beginning, although it is consistently upending what we would consider a normal rate market. I don't know whether you're rate-driven. Explain a little bit about how you derive what rates you charge people.
Because these are portfolio products, the rates are much more stable and not as fluctuated based on the movements of the market as a whole.
Mm-hmm.
These are going in portfolios and are going to be serviced and for long-term, residual income, if you will. So the day-to-day movements of Wall Street and the lack of liquidity affecting securitization really doesn't affect. So the rates are very competitive in the climate we're in and under the circumstances that we're in.
No, that's good to know. And if you don't mind, I don't want to hedge you in or hem you in, rather, by giving us the exact rates, but give us a ballpark of where you are and starting in some of these loans.
So on our bank statement loans at a 55 LTV with a 680 or better score, you'll probably be somewhere around the low to mid fives on an owner occupied and the higher fives to non-owner occupied. Once in a while, you'll venture into the low sixes if it's got, higher LTV, lower credit scores, things of that nature. But we range between the fives and low sixes.
Okay, we got a minute left. I want to have people get your phone number. Could you shout it out for us, or a way by which they can get in touch with you, knowing that these products are available? Probably want to get to you right away.
Yeah, my phone number is 310-498-2700, and that's direct to me. My name is Mayer, M-A-Y-E-R, and my email is Mayer, M as in Mary, A as in Apple, Y as in Yellow, E as in Edward, R as in Robert, at mbank, M as in Mary, B as in Bravo, A as in Alpha, N as in Nancy, C as in Charlie.com. So Mayer at mbank.com. You can reach me at any time, 310-498-2700.
Mayer, thank you very much. I want to do this again. You've been very informative and helpful, and obviously supplying some great information to people who probably will give you a call. Thanks very much.
Absolutely. Thank you so much. And one last thing, if I can, we're also doing commercial loans up to $30 million.
Oh, no. Yeah, talk about burying the lead. All right, we'll get to you in the next show. Thanks very much again, Mayer.
All right. Thank you.
Thank you very much. Bye-bye. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. You can hear this show on a number of podcasts. We're on Apple Podcasts, Google Music Play. We're on, I don't know, there's 8 of them on the big 8. So if you see us, hear us in any of these locations, give us a review. Why I ask you to do that is because if you do that, other people can find the show. The information on the show is important. It's important now more than it has been because you need to know what outlets are available out there for a loan that you want, if you can get a loan, and how much it's going to cost you. If you want to see the show, The show is The Mortgage Voice, Jeff Barton, The Mortgage Voice on YouTube. We've been there for a number of years. The website, of course, is themortgagevoice.com. We're on LinkedIn every day with a minute, mortgage update, as well as Facebook and all these other social media outlets. And I'm exhausted just doing that every day without doing my regular job. But for those of you who enjoy that sort of thing, another person who I bring on the show occasionally when she's got some time is a terrific resource for us and for you, and that's why I like to have her on the show, is Michelle Wild, the Divisional VP from Orion Lending. Michelle, how are you?
I'm wonderful. How are you?
Great. Thank you very much, and thanks for coming on the show. I know how busy you are, especially nowadays, trying to answer questions and solve problems.
Absolutely. That's my day every day.
That's the lending world day. All right, give us a typical day that you are going to spend now, and maybe mix in there some of the programs and some of the solutions that you're bringing during this crisis.
Well, it's an interesting time in the mortgage industry. We have many different lenders that are not taking loan applications because either they're concerned about the market or they're just so busy that they can't accept new applications. So if you're out there and you're trying to apply for a mortgage and you're frustrated, there's a reason. Beyond everything else that's going on, a lot of the credit scores have gone up from what they were in the past because of this COVID situation. It has definitely put a crimp in the mortgage lending industry. I will tell you the lenders that are accepting applications and the lenders who are funding loans are very, very busy. You will find when you apply for a loan that your turn times are extended. It's taking longer to fund a loan. There is hope. There are lenders out there funding loans. There are good lenders that have made very smart business decisions over the years, and you find that the people and the companies that did that will end on the other side of this stronger and still able to produce and provide that service to the public. So there are strong lenders still out there. Don't be worried when you see some of these people not accepting applications. Some of them will open it back up once this is over with. There may even be some lenders that go out of business. And I think that when we see that, people get a little nervous thinking back to what happened in 2007. And I really don't believe that this is going to be another 2007.
I agree with that.
Yeah, still agree with that. The average day is crazy. I mean, my employees are waking up and starting work at the crack of dawn, and they're not ending work until, sometimes 8, 9 o'clock at night every day, and working weekends to try to accommodate the business that we have. It's an incredible time, and I think that the average person, should be confident that there are plenty of lenders out there that will be there to fulfill their mortgage needs through this transition that we're going through. And then when it's over, the people who are remaining, the people who stay in business are going to be strong and able to handle the business.
Let me ask you a question on criteria. You said credit scores themselves are going to go up a little bit in terms of the requirements for the loans. Name some of the other requirements that are different today than they were 6 weeks ago in terms of accepting applications, not only accepting, but approving and funding.
Well, there's number one, 6 weeks ago, many lenders were able to go and do an FHA purchase mortgage transaction all the way down to a 580 FICO score. The majority of lenders out there are now not lending under 680, but there's a lot that will go down to 640. It's a time when if your score is under 640, it's going to be very difficult to close your transaction. And I definitely would recommend that if you're in that predicament, that you go and analyze your credit and figure out what you need to do to boost your score. And it may be a time that you have to rent for a year or at least 6 months until you get your credit turned around.
Is that the same advice you're giving people who've lost their job with the promise of getting it back once the crisis is over because they have this gap in employment?
We're seeing two different things with people who have a gap in employment. So you have some people who are on furlough, but they're still getting paid. So their employers are still paying them their full pay, or at least their full base pay. for somebody in that situation, I can still fund a loan.
Right, of
But
course.
if somebody's on furlough and not being paid and are on unemployment, they're going to have to wait. They're not going to be able to fund their loan. And and it's not a time when you have lost your job. It's not a time to do a refinance. A refinance is not the answer. You can't, to refinance a loan and then have to ask for forbearance is definitely not the answer. So
right.
if you have lost your job, you should stay kind of put where you're at and try to do your best to work it out.
Okay, that's a good, and you know what, that's honest and straightforward. It's not saying to people, well, let's take a look at it, let me see what I can do. It's saying, look, if you're in a situation where the lender who's going to give you money is looking at forbearance within a month or two, that's not good for you, it's not good for the system, and it's certainly not good for the lending industry, because getting loans stuck, whether it's trying to sell to Fannie and Freddie or whatever the investor is the only good thing that comes out of that is no good thing, meaning that we'd have a clogged up system and funding loans would stop. And that leads me to my next question, the liquidity. How are you all over at Orion fixed for liquidity, for funds flowing through to make sure that that doesn't stop?
Well, the thing that we've done at Orion to position ourselves to be very strong going through this is that over the years, we have never had a business model where we funded loans at a loss. It sounds weird, right? Why would anyone do that? But
Right.
over the last 2 to 3 years, you've had several lenders out there producing rates that are so low that they're literally funding the loan at a loss to try to make the money up on the servicing after funding. And the lenders who did that, you are seeing them having severe liquidity issues, because what the general public doesn't understand is that when files go into forbearance within a certain period of time, or when there's a 30-day late within a certain period of time, we have to, as lenders, buy those loans back from where we sold them to, and that's where it comes into play. So we have these margin calls. And margin calls could be a variety of things. We have had margin calls, but the reason that we've been able to come through this and be so strong is because we've positioned ourselves financially to put those reserves into place. So when those margin calls happened, we had the money ready to go to pay the margin calls immediately. Whereas a lot of other lenders out there had these margin calls, they didn't have the money available because they spread themselves too thin, and they had to go and borrow to meet their margin calls. And if they weren't able to make those margin calls, they were no longer able to fund loans.
I agree. I mean, I think a lot of what we do in the industry is try to come up with ways to make money, but it sounds like in your particular business model, you did that and you didn't compromise by trying to, as you said, buy loans, which is selling them at a loss in order to keep the servicing. People don't understand that, the servicing dollars that you spend every month on your mortgage, somebody's making money on that. But if it's the lender, there's something wrong with that particular business model. I agree with you. Let me ask you another question. We're coming up now, I guess, almost in the summertime. The coronavirus itself, we've been told, is not long for this world when it gets hot. I for one, respect those governors who are, yes, trying to protect, but also understanding that business has to get back to business, or else we won't have a country left. What are your feelings on that, and what are they doing down in your neck of the woods?
I could not agree with you more. I respect life, and I respect the fact that this virus is kicking people's rear ends. It is really serious. For certain demographics, it is very serious. But we also, the cure cannot be worse than the punishment. If we shut down America, which we did, which I respect the fact that we all did that. Everyone made a big sacrifice, right, so that we can protect those vulnerable populations, so that we can limit the amount of death that is going to occur. But we can't eliminate our capitalism and the way we do the way we live. If we do that, then it's going to be a very scary time. I'm a firm believer in capitalism. I do not believe in socialism whatsoever. And I think that the governors in the states, there's plenty of states that have very little virus. And I
Right.
think those states will be opening much faster than other states. I have to give, I am a conservative Republican, but I have to give California's governor props. He did a fantastic job because the numbers in California for this virus compared to the population is absolutely impressive.
Yep.
But at some point, everyone needs to get back to work. There's no way that people can continue. We cannot continue to keep passing stimulus money.
I agree.
To people at home. It just does not financially work.
No.
So when in the states that can open up responsibly, I am a firm believer to do that.
I agree. I agree with all of that. Michelle, could you shout out a phone number where people can get a hold of you, especially if they're looking for a solid lender who can continue to lend?
Absolutely. You can reach me directly at 714-266-3013 or 602-663-6178. And I have brokers who are in every state in the country. So depending on where the borrowers or people are listening, I can definitely refer you to very good people in almost every state in the country.
Excellent. Michelle, thank you very much for coming on the show, enlightening us and telling us about what's going on from your perspective in the lending industry. It's a tough time, and I appreciate your honesty.
Absolutely. I appreciate you having me on. And as always, thank you very much.
Thank you very much. That's Michelle Wild from Orion. She's the divisional VP. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton for The Mortgage Voice. Thanks for tuning in each and every week. We are on Google Music Play. We're on our podcast on Apple, and as well as many other podcasting stations, and where we can I stop for a second? I'm getting feedback. What is that?
We can fix that.
Okay, great. I don't know what it is, but okay. Welcome back, everybody. I'm Jeff Barton, your mortgage from the Mortgage Voice. Thanks for tuning into the show. We are on Google Music Play. We're on Apple Podcasts. We're on a number of different podcasts, the Big 8. If you want to hear us, go to one of these iHeartRadio, any of them, and plug in Jeff Barton, the Mortgage Voice, and you can hear us. We're really grateful to be able to have that ability. Thanking to KCAA, KMET, K-Tahoe, as well as K-Ship up in Las Vegas, Nevada. All these fine stations also carry us, and we have a video feed there and on our YouTube channel. So if you go to any of these sources, leave a review, click away by which we can update you, notifications on now and future shows. If you go to YouTube, Jeff Barton, the Mortgage Voice, that's our news channel. That's our channel that we've been on for 5 or 6 years. And www.themortgagevoice.com is our website. We were talking earlier and have been throughout the show about programs that you can take advantage of during this time. One thing we did not talk about was some of the real estate values and how appraisers are going to your house or not going to your house, and how these prices and values are derived at right now. We have low inventory in the marketplace, so it's a supply and demand issue, really. If you're out there right now and you want to buy a house and you're looking at the inventory that's been sitting, that may be a good opportunity for you to bid on something a little bit less than asking price. But sellers are stubborn, and I should emboss that on my t-shirts. Sellers are stubborn. The reason I say that is because sellers themselves take about 6 months before they realize the market conditions have changed. Now, I don't know if it's justified right now to drop price below a certain amount. I do know that nationally we've seen a 10% reduction in prices, and we've seen more negotiations and less multiple offers. All of this tells us that demand is down. However, when you talk value to a seller, they always point out to you 2 things. One, my house is better than any house on the block. And 2, this is just a blip on the radar. These prices are going to go back up, and I don't want to miss out. And I can't say that either one of those is wrong. However, it is a constant in the 25, 30 years I've been in the business that market conditions never turn around quickly, and they never flip on like a light switch. Again, however, in this particular case, this is a man-made disaster. This is not market conditions. This is not Lincoln Savings back in the 80s. This is not the internet bubble in 2000. And this is certainly not the mortgage meltdown of 2007, 2008. This pandemic is something that all of us are agreeing to not work for 8 weeks. That's kind of been the agreement between me, my customers, my employees. Now, most people believe, as I do, and contrary to what I've been just telling you, that as soon as people go back to work, the 22 million people on unemployment, the 3 million people in forbearance will be able to get their jobs back and start paying their mortgages. That's what I think is going to happen. Now, it may not happen tomorrow or May 1st or May 15th, but by July 4th to the end of July, you're going to see a great many more people working, and certainly the forbearances falling. I think forbearance, what they asked for was 8 weeks. Or maybe it was 90 days. I think it was 90 days. Is that right, Daryl? Do you think it's 90 days?
I believe that's true, yes.
Yeah, I think 90 days is what they asked for in forbearance. And for those of you who aren't familiar with the show, we are in different locations, obviously. And Daryl and I were talking about how it has changed in terms of what you see at home today versus what you saw in the first few days. And what you see today is a little bit different, i.e. the technology is a little bit better. People are more comfortable with talking in this long distance environment. And because we are using Zoom, and I really appreciate that company's help, obviously, they do a terrific job, as does a couple of the other online things that we've been using, Facebook Live, Instagram, LinkedIn. We are posting videos on a daily basis called the Mortgage Minute. And in those Mortgage Minute, we are talking about what is happening that day. One of the things that we do talk about on the show every week is who's doing what and what can we expect today. So let's talk about that for a second. Who is doing what? Everybody's doing conventional loans. Everybody. And I mean companies that weren't doing conventional loans, i.e. those that were doing non-QM, non-qualified mortgage loans. Those are the loans that are bank statement loans, business bank statement loans, stated type loans, loans with 10% or less down with a high LTV and low FICO scores. Yeah, you'd pay a little bit more at that time for your rate, but you could get service. Today, there are very few companies doing those type of loans, and their parameters have changed. However, Sprout Mortgage is doing them. Who else is down here? Let me see my list. Impact is doing them. Axos is doing them. I'm sure there are other lenders that are doing them, but those three I know right away. If you're out there and you're listening to the show and you need somebody to either introduce you or take a loan application because you were in that type of business or a type of bank statement type product, we can help you with that. And you can either email me or dial the phone number at the bottom of the screen. Now, if you are in trying to do down payment assistance programs, we heard today that, yes, you can do down payment assistance programs. And there's a company that is a niche, that is their niche, that is what they do, and they're continuing to do it, whether it's the CalHFA program here in California or some of the other states where we do lend. They have their individual states, and certain counties have it. Yes, we're doing down payment assistance programs. If you're looking at FHA programs, absolutely. Now, FHA is a good product in a time like this. We know the conforming limits in each and every county are whatever they are. Let's say in San Bernardino, Riverside County, they're $500,000. I know they're more, but let's just say I think it's 541, but let's say it's 500,000 in San Bernardino County and Riverside County. We know that FHA will lend 97.5% of that loan to value, loan to whatever the value of the home is. And that's a good thing for you. You will pay more. I think today FHA rates are at 3.75%. And if you tack on the 1.25 to 1.5% funding fee as well as what the rate will be, obviously you're going to pay more in the rate. However, you can get that loan. And if you have low down payment, and if you need the type of assistance that I think you might need if you're looking at FHA, that's good. Now, will real estate prices fall? Will they finally match what the demand is? Yes. However, like I said earlier, I believe that the light switch will be turned on. I believe that in 2.5, 3 months from now, we will see a lot of this in our rear view mirror and a lot of the country back to normal. Now, everybody, and this is quite typical of the U.S., in terms of any issue that comes up, whether it be Russia hacking the election, whether it be Hurricane Katrina, whether it be, I don't know, name your disaster. Name a national headline that has taken hold in your world where you're very concerned about. The media beats it to death until all of a sudden it is meaningless because the fear surrounding coronavirus, hey, my family's afraid. We're afraid. However, we will get through and by this, and sooner than later. And I believe by the end of June, we will see a lot of this in our rearview mirror, that we will not see a resurgence in the way they're predicting, and that the country back to normal, i.e. people working, is what we're working towards and what we need in terms of helping the country along. Certainly the mortgage-backed securities need it. Certainly our investment in housing needs it. As we all know, construction has maintained their place in importance in the economy. They're still working. So housing, yes, we need more housing. And I believe most of this will be behind us by the mid to end June. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.